Usually when there's a stock price that drops significantly around earnings time, we'll take a look at the bad news, and it's pretty easy to see what the cause of the drop is. And most of the time it seems over the past year or so that the firms we've looked at that have dropped dramatically, that drop didn't necessarily merit such a significant correction compared to the news that was made available. Well, when Quanterix dropped today, we took a look at the news that was available that accompanied their Q2 2022 earnings, and there were so many red flags in there that it was really tough to get through all of it. And we had sent an alert to our paying subscribers saying that we didn't think there was enough information there to merit a full article. Well, it turns out there was plenty. So we published a research piece alongside of this video, and I'll link to that in the description. But what I wanted to start with quickly is talking about the reason that we invested in Quanterix to begin with. So there's a theme that surrounds this called proteomics. And if you've seen anything about the accomplishments that DeepMind has been making in being able to predict the way all of nature's proteins fold, that's just over a year after it first was able to predict the shape of a protein. We now see a lot of work going into this area known as proteomics. And you can see on this chart here in the upper right-hand side some of the focus areas for proteomics, which is the study of proteins. So Quanterix, and you can look at our original, I would say, thesis for entering the company. I'll put a link to that piece. We published that about a year ago. And it talks about the usages of their platform and whatnot. And you can see here on the right, this is pretty important. It's the number of instruments they've placed. And this is similar to an Illumina business model. They're going to place instruments and they're going to sell high margin consumables, and that'll turn into a cash cow over time, provided that the industry adopts their solution, right? So they aren't the only ones dabbling in proteomics. We also wrote a piece on 7 proteomics stocks out there, and we'll look at those in a second. But this firm we saw as having leadership just based on revenues and the fact that the platform they've built has a remarkable level of sensitivity. And of course, there's an assumption there that sensitivity matters. We don't necessarily know that's the case. So the next time that we looked at Quanterix as we were adding shares over time was when there was some drama with this firm called Cassava. And Cassava had addressed a series of allegations regarding some biomarker data they presented at an Alzheimer's conference. Well, they were challenged on this and they blamed Quanterix for faulty data. Well, Quanterix came back with a press release that said they didn't produce the faulty data in question, and Cassava remains under federal investigation. Now, the reason that I bring this up is because we issued an alert to paying subscribers around the time this happened, and we had questioned the accuracy, or said, let's say we proposed various scenarios that it could have been the case, and one was relating to accuracy of data. And it just seems right to bring this up because although we can't find any sort of conclusion that was reached here, this was something that happened which is hard to dismiss in the face of what we're learning in today's earnings call. So let's just start with the basic problem, and that's that the revenue growth has stalled. So here on the left, you can see everything was going good. That's some nice, strong revenue growth you see there. Of course, they're losing some money, but that's to be expected as they move to capture market share. Left is annual, right is quarterly. So you can see in the, let's say, first part of 2020, they had the Rona hit there, and then they recovered from that. And then you can see moving to the right, things appear to have plateaued, and that red line, that's what they announced today. So quite a drop, and also certainly something that isn't making the trend for next year's revenues to be higher than 2021. Doesn't make that look very feasible. Now, when we look at the actual drops, here's a big problem. So we look at consumables as a proxy for usage. In other words, if clients are using machines, then consumables are being sold. And you would have seen a similar problem with Berkeley Lights when that short seller pointed out the fact that consumables weren't growing. So you can deploy as many machines as you want, but if you don't have consumables revenues, they're not being used. And this is a big problem. We see a reduction in use of 29% from last year, so Q2 2021 to this quarter. But what makes it worse is if you look at last quarter, so Q1 2022, they saw 14.4 million in consumables. So this quarter we see 9.2. That's a drop of 36%. So more than a third. That is very significant. Well, what I wanted to point to here that's kind of a segue into what we're going to talk about is the growth of accelerator revenues. So that's the only shining star right now. They're not selling more instruments. Consumables have plummeted, but they are growing some services, it looks like, and this accelerator bit. And noted in their earnings call, they said the work that's done in our accelerator lab includes a lot of initiatives around quality. Well, quality is what we're here to talk about today, because this is probably the most impactful statement that's given in the earnings call that investors should pay attention to. And it says this: operations and ability to scale have not kept up with growth in customer demand for our Simoa technology. That's their platform. This has manifested itself into quality challenges that will, in the near term, have impaired our growth rate. So quality problems are affecting the growth of their business. Now, this was taken verbatim from a Motley Fool transcript. I don't know what's going on with their algorithms, but whatever methods they're using to just transcribe aren't working very well. So you kind of have to read between the lines here. And I think reading between the lines is what you need to do when you analyze this entire earnings call. And what's interesting to note here, so another big piece of news, the chairman of the board exited around all this information coming out. One of, big piece of news, chairman of the board is exiting. Well, if we look a little bit into the past there, we can kind of read between the lines. And it starts in June of 2014 when this gentleman, Martin Madaus, he left his role as executive chairman of the board at Quanterix to go to Ortho Clinical Diagnostics. The background there is that he was an advisor for Carlyle Group. Carlyle bought that division from J&J, and then Martin Madaus went over there to lead that. And when he left, he handed the reins over to this gentleman, Kevin. I'm not even going to try to butcher his last name. So Kevin comes on board, and he becomes the chief executive officer. All right. So he's running the company for quite a significant amount of time. Well, then this other gentleman in May of last year, Masood, and again, I'm not even going to go with these people's last names. Masood came into, and this is important to pay attention to, oversee Quanterix's growing diagnostic business and assume responsibility for the company's accelerator lab services. So this gentleman came from a large life sciences firm where he had grown his diagnostics division to be 50% of the company's revenue. So according to his resume, he's a badass, right? So he comes in at this role and he does a strategic overview of the company. And the next event that we see here is where the chief executive officer, that gentleman that came in 2014, he now moves to become executive chairman of the board. And Masood is now replacing him as CEO and also joining the board of directors. Seen this in other firms, well, they'll bring in some hot shot and they'll kind of sit there and analyze things, and then pretty soon they put the wheels in motion. So we see that the CEO has been replaced, and what would seem to be kind of a promotion for Kevin actually didn't work out too well. So months later, he's shown the door. Well, the gentleman, Martin Madaus, originally from June 2014, that original chairman of the board, comes back to fill the role he left back in 2014. And it just so happens that the company he was working for, Ortho Clinical Diagnostics, was sold, I think, several months ago. So this all adds up. This makes sense. This is kind of I guess it's a little bit of a vote of confidence. So that gentleman, Martin, had never left the board, and he watched things, and then they put this in motion, and it's likely that they knew that the bad performance was happening. They were trying to correct it, and they ended up everything coming out on the table today. And if this is a competent management team, we can hope that they did bring everything out on the table and that they tried to paint the worst picture as possible, which they did a good job of doing that. and there's only upside from here. But there's some problems when we think about what's happened. So first of all, who wants to purchase life sciences instruments that have stated quality issues? So they talk about, well, you see this line here, this is verbatim. We have set in motion an assay redevelopment program, back to the drawing board, with the objective of improving our ability to manufacture and deliver high quality assays at scale. Great. So there's a theme in this call where they talk about the strong demand, like they can't meet the demand. There's so much demand for what they're producing, but they can't meet that demand. And there's this talk of rework where they haven't been able to scale their manufacturing processes, which leads you to believe they had some incompetent people working there, and they haven't been able to meet demand. So there's a question about them being able to do that going forward. And they had a comment in this earnings call about shipping 10 machines to a startup and they hadn't recorded revenue until they were going to receive it. Well, if you're worried about receiving revenue, don't ship machines. So hopefully they're not engaging in riskier sales. We saw Beco Group do that, right? They engage in riskier sales to try to keep those numbers up. Well, there's this idea that now that they've talked about quality issues, how many new customers are going to want to come on board until those quality issues are fixed next year, which is when they anticipate that will be finished up. And then what's the messaging been like to existing customers? And somebody in that earnings call had probed about, quality impacting the end customer. Well, the dramatic drop in consumables revenues implied there was customer impact. I mean, that's a problem because that compresses margins. We'll talk about that. Those high margin consumables, it compresses margins. It shows people aren't using the equipment. That's not good. And then guess what? They laid off 25% of their workforce, 130 people, and really signals, they said, well, somebody raised the question, well, does this hurt morale? And how does this bode for your guidance for 2022, which is flat on 2021? And the comment was, well, we've simply focused our resources and they're going to save, I think, 25 million a year with the headcount reduction. And they still have some more to go on that in terms of the buildings they were leasing that they no longer need. But again, this year, for 2022, they're expecting revenue to be flat compared to last year. And then they say on a longer term basis, we expect to return to double-digit revenue growth in 2024. So now the biggest problem here probably is that they're not alone. So if this was an Illumina and they had, their market share leadership and they were retooling some things, that might be a different story. But they are in a very competitive space. And in that previous piece, we looked at some of these other firms, and our research piece will link to articles that we've done on some of these firms. But you can see here, we've taken most recent market cap and, more importantly, annualized revenues. So look at how tight it is with SomaLogic and Olink. And when we had looked at these names, I think we had shortlisted two. That would be Olink, and you could see Olink is, according to our simple valuation ratio, quite overvalued compared to the rest. But you can see how they're kind of neck and neck when it comes to annualized revenues. And this setback for Quanterix, that's going to let their competitors muscle in. And if you're a buying manager looking at instruments, are you really going to want to take this risk with a firm that's, retooling or back to the drawing board and trying to fix products that have very low levels of quality? So there's an opportunity cost associated with holding Quanterix. If we continue to hold our position, first of all, we wouldn't buy shares of this firm for any number of reasons talked about today, but also because they're very small and we're already overweight small caps and they're under our 1 billion market cap cutoff. And this is just becoming a disaster in terms of what's going on with this firm. By the way, that is a good segue into the conclusion. So this time setback obviously gives their competition a leg up. So we talked about that. The opportunity cost for us associated with holding this is that we have to pay attention to something that is now playing catch up, whereas we could be paying attention to something that isn't playing catch up, that's actively growing and not running into problems. And I think when you look at when we sell a stock ever, there's two reasons. Our thesis changes or growth stalled. Well, you could argue both have happened here. So we invested in this firm because they had revenue leadership. Okay, that seems to be going by the wayside. and the sensitivity of their product. Well, if you're having quality issues, it doesn't matter how sensitive it is. So our thesis has changed in that respect, and growth has stalled. It's stated by the company now. So buying more is certainly not an option. The platform they have today is not economically viable. Those gross margins, by the way, came in at 28% last quarter. And I'll just finish up on that. The gross margins were compressed not only because of the lower sales of consumables, but also because there were freight costs they were incurring when selling products that weren't be considered actually meaningful as well. And there were other aspects that weren't being included around that rework that was happening. So the actual cost to produce their products, that gross margin, right, which is revenue compared to the cost of goods sold went way up. Now they're sitting at gross margins around 28% compared to 47% last year. And of course, half of that change, they said, is related to the reduction in use of high margin consumables. But the other half is that they weren't in their accounting correctly classifying where things should be. So one thing that you'll see people say, that this firm has $360 million in cash, which they, after making their cuts and cleaning house a bit, should be able to last them through this plan. If you look at their burn rate and everything, they should be in good shape. But what's really interesting here is if you take $10 a share, what's the price of shares today? $7.46. The market actually values the cash that they have on hand less than it's worth. And what does that mean? Well, and some will say, well, it means a bargain to be had. But if you look at firms like Nano Dimension, they had, I don't know how much money, let's say hundreds of millions of dollars, and the value of the shares was less. That's because investors didn't think those people could put that money to work and actually generate a return. We happen to fall into that camp. Whereas others would say, look at the bargain to be had here. And we wrote a piece on that. I'll put a link to that in the description of this video. But you could argue, as people will, that there's a bargain to be had here, buying $10 a share in cash for $7.46. That's certainly the case. We're very concerned. So while we'd like to think that the market has severely overreacted, sophisticated institutional investors don't see an arbitrage to be had here. That's a big concern. So in regards to whether or not we sell this stock, we had sent our paying subscribers an alert earlier today and had said that if we do decide to exit our position, we'll send them an alert on that. And that's where we're going to finish this off today. So please put your comments in the comments section. Make sure to subscribe to our channel and share it with your friends so that can help boost our brand. Thanks so much for taking the time to watch this video today.